Hi, I'm Matt Collins. I'd like to welcome you to Bob Weber Auto Mart on Douglas Avenue here in Racine, across from Douglas Park. We specialize in 1-year-old, low mileage, almost new cars. And if you'd like to stop by and see them, or see them on our website, bobweberautomart.com, we could save you between $5,000 and $10,000 on your next almost new car purchase.
I'm Michael Burke, and this is Money Talks. Hi, welcome to Money Talks. I'm business reporter Michael Burke in the JT studio, and today we're with Justus Morgan of Financial Service Group in, well, I guess you guys straddle Caledonia and Mount Pleasant, but you're in the Racine area. Anyway, Justus has been on this show before to talk about U.S. savings bonds about a year or so ago. And today we're going to talk about something called evidence-based investing. So I'm going to hand it to you by asking you, what is evidence-based investing?
Sure. Evidence-based investing, Mick, is simply looking at the research and the evidence of what factors contribute towards investment success. Not only the things that contribute, but also what things don't work. And what's fascinating is there's a lot of studies, there's a lot of information out there that's been compiled over decades that points towards certain things that don't work as well as things that do work.
Let me just quickly jump in and point out, so evidence, we're not talking about evidence that a certain company is a great company or something like that. It's evidence of behavior and strategies and methods in investing.
That's correct. Typically, it's empirical research. Typically, it comes out of academic institutions, professors that are looking at the data, trying to figure out what contributes to investment returns, what strategies actually work. So they're looking at a wide range of data that they're kind of sifting through to figure out what's actually successful.
Mm-hmm. What are some of the typical mistakes that investors make?
Yeah, I think what some of the research is pretty convincingly demonstrated there's really two areas that typically don't work and where people often make the most mistakes. One of them is simply trying to time the market, trying to get an idea of, well, when should I buy in, when should I sell out, thinking that there's some way to forecast the future. And it's a pretty prevalent approach. You turn on the television, you pick up a magazine, and there's lots of people trying to give you that inside edge. And the research shows that to be able to do that consistently, right, year after year, it really doesn't happen. Mm-hmm. The other area that people...
So an example of that, by the way, is just a certain sector of the economy is booming. The dot-coms were booming, right? So everybody was jumping on that bandwagon. Sure. We know how that ended, right?
Exactly. And so history's kind of littered with great examples of where people have tried to figure out is now a good time to get in. So in the late 90s, we saw the dot-com, the tech bubble, companies that, when you looked at their fundamentals, they weren't profitable, but yet people thought, well, this is the new normal, this is the new economy.
Tech stocks have to work. Yeah.
Exactly. Yeah. Inevitably, those things don't pan out.
So timing the market.
Right, timing the market. The other aspect of it is trying to pick individual companies. So timing the market is a more broader approach, whereas the security selection is looking at individual companies, really trying to find that next Microsoft, that next Apple, of course in advance. And once again, the research is pretty conclusive that being able to do that consistently is very difficult.
How do you counter when you're talking with a client or someone and they say, yeah, but look at the people who bought Apple stock early, look at the people who bought Amazon stock early, they're rich, Walmart stock. How do you counter that argument?
Well, of course, if you knew in advance that those companies were going to do so wonderfully, then perhaps you'd be rich as well. But the challenge is knowing in advance which of those companies, and there's certainly people that bought those companies at a much lower price, and now they look back and say, how great of an investor I really was. But you look at all the other people who either didn't or said, no, that's a horrible stock to buy. And so when you look at all of the evidence, not just the individual success stories, you get a much broader and clearer picture.
Now, I don't want to use any local companies as examples, but what about, let's say, does it ever make sense to buy an individual stock? Let's say you are absolutely convinced that solar energy is the future. You know of a company, it's got great management, it's starting to show a profit. I mean, everything looks great. Mm-hmm. All the signs are pointing to success in that industry, and you found a good company. What would you tell somebody who said, I really want to own that stock?
Yeah, the interesting thing about that is a lot of those ideas are already factored into the price of that stock already. Mm-hmm. So, well, it's a great idea that you had. Chances are somebody else has already had that idea. And there's a lot of money out there that's being invested. And so, these new pieces of information come out so quickly and they're reflected in the price even faster that to try and get an edge is incredibly difficult. Mm-hmm.
No, go ahead.
Yeah, so I was just going to follow up with individual stocks. Our attitude around those is you can occasionally buy an individual stock more as a form of entertainment than as part of your serious investment portfolio, mm-hmm. simply because it's much easier to diversify and achieve that investment success through broad baskets of companies versus trying to focus in on a few at a time.
A lot of this is emotion, right? What are the emotions that are at play when people are dabbling in the market?
So that's actually, I want to say, a relatively new area of research, even though it's been around for a few decades. There's a lot of energy going into it right now. It's a whole area of behavioral finance, and they define them as different biases. So we're all humans, right? We all have certain emotions. A great example is overconfidence. So the fact that you came up with that idea that solar energy is going to be a great place to invest. So now you're thinking, that's my idea. Well, guess what? You're probably a little bit overconfident mm-hmm. that's actually going to work out. Uh-huh. And so understanding what these biases are, and there's a whole slew of different types, and having some awareness of what those biases are can help counter the negative effects of those.
How about greed? Is that an emotion that gets in the way?
Yeah, probably the two extreme emotions that we see are going to be greed at one end. So best example of that is the late 90s, the tech mm-hmm. bubble, right? People saw all these companies, their stocks going up. They just said, I want some of that. Mm-hmm. So everybody starts piling on. And to a certain extent, if that continues, that's what leads to some of these bubbles, right? People are just constantly buying with really no underlying reason for it. And at the other end of the extreme is fear. So you've got greed and fear, and they materialize at those extremes. So at the top, you typically see greed taking over, and at the bottom, after you've seen those significant declines, people become very fearful.
You brought a book, I think, that fits right in with this. Do you want to mention that?
Sure. This is one of my favorite books. It actually came out last year. It's called The Behavior Gap by a fellow named Carl Richards. The beauty of this book, Nick, is it's very easy to understand. Carl actually made a name for himself by he uses kind of the back of a napkin illustration where he takes what are arguably pretty complicated ideas and topics and simplifies them down into very easy.
I love this. It's an up and down graph, and at the top it says greed/buy right at the peak, and then at the bottom fear/sell, and then repeat until broke.
Yeah, exactly. So one of the objectives of evidence-based investing is to try and flip that on its head, right? And to try and remove emotions as much as possible from some of the investment decisions that you make. And often that comes in the form of discipline, having a process. So looking at your investment approach, not from one of a collection of companies, like, ooh, I want this one or I want this one, but rather understanding how everything interacts with each other in the portfolio and having some systematic steps in that process to counteract those emotions.
I want to get to the what you should do part of the conversation in a second, but you had actually shown me a bar graph. We're talking about evidence-based investing. What does the evidence show? Remember that gap? Explain that.
I do. So actually the title of Carl's book, The Behavior Gap, comes from an ongoing study that actually looks at the difference between the rate of return on the stock market or the bond market and actual investors' rate of return. And they're radically different, to the point where the actual return on the market can be up to double what the investors are experiencing. Mm-hmm. And the question becomes...
And that's the gap we're talking about. You could have had
exactly.
You could have had this, but instead you tried to do it yourself and you only had this much.
Right. And inevitably it's the investors' emotions that often get in the way. So they're putting money in at the wrong time, they're taking it out at the wrong time, and as that illustration demonstrated, you do that often enough, and the results are not good.
Not to mention, perhaps a retired person, but who else has the time to do such extensive research on these companies and stay on top of them to really know, right?
Yeah, and that's, I think one of the other areas of the evidence that points to not having to spend the time to analyze each and every company, but rather take a much more diversified approach. So instead of just buying a handful of companies, buying hundreds, if not thousands, of individual companies.
Okay, so which leads us right into, we talked about some of the mistakes that some investors can make. So what should people do? Yeah, so some of the things that the factors that I think you should focus on, the good news is there are things that are actually under your control. Okay. And so I think that message is really important, because you can't control the direction of the market. We have no knowledge of where it's going to go. But there are things that we do control. A great example is costs, right? The amount of expense that we pay for our individual investments. It fluctuates all over the map. And not every mutual fund is created equally. You can look and see how much you're actually paying for those investments. And the research shows that there's an inverse relationship between the cost and the performance, meaning that the more you're paying in expenses, typically the less... The worse the return? The worse the return. Exactly. Boy, that's a great indicator right there, speaking of evidence. But let's back up a half step. You sort of implied this, but you talked about hundreds or thousands of companies, so that indicates a mutual fund, right? It typically does. So that's one of the ways that you can save yourself a bunch of time, is instead of you trying to pick out each one of these individual companies, Mick, you actually buy a mutual fund, which is simply a basket or collection of individual companies. And there's literally thousands of different types of mutual funds that hold different types of stocks. Some hold bonds, some hold a combination. And part of the investment strategy is to try and figure out what combination is appropriate for you. Okay, so let's stay with that for a second. Sure. You've convinced me that I should be in mutual funds. One big factor is the cost. What's the range in interest? I guess interest isn't the right, but the percentage that you're going to pay per year. Sure, the operating expense is typically how it's framed up. The average mutual fund expense is, say, anywhere from 1.2 to 1.5% per year. Mm-hmm. So that's the average. At the high end, we've seen funds well over 2%. Mm-hmm. At the low end, well under 0.5%, all the way down to 0.1% or less. And so that's a pretty wide range. Right? Although some people would look at that and say, it's just 2%. Yeah. So, but it makes a difference, doesn't it? It absolutely does. Over a period of time, when if you're only earning 6, 7, 8% a year, and 2% of that goes out the window for expenses,
Well, that's a quarter of your return right there.
Right.
It just got eaten up.
Okay, so that's one of the things you should look at in picking a mutual fund. And you said some are in stocks, some are in bonds, and some have a combination. And what does that tell me when I'm at that point?
Yeah, so the research also is pretty...
Because stocks make more money than bonds, typically, right?
It depends.
Okay.
Yeah. That whole idea of diversification, right, is that concept of not putting all your eggs in one basket. So the research looks at, okay, what does that actually mean? How do you diversify? Well, there's a couple of ways. One is to divide the money between stocks and bonds. Even within stocks, you can look at U.S. companies, international, so on a global basis, recognizing that there's a lot of investment opportunities outside.
You're saying that some funds would tend to be more in the international companies, and some would tend to be more in the U.S. companies. So
exactly, and then you can also further divide some of the funds into small companies, large companies. What we'll often find is people will look at the list of investment options in their company retirement plan. So maybe there's a dozen options or so, and one of the things that you really don't want to do is look at the performance and just pick the one with the highest performance. Even though that sounds like...
It sounds illogical not to look at the performance.
It does. Because the challenge with that is that performance is linked to a particular time frame, right? So over the past year, one fund may have done much better than another fund, but when you're looking at holding that fund for literally decades, you've got to change your mindset around and actually look at a number of different types of funds. So you really have that diversification. So we'll see people that have 5 or 6 different funds and think, oh, I'm diversified. But if you actually look at what do those funds hold, they all hold the same thing. And so therefore that's really not a diversified portfolio.
So ratings of how a particular mutual fund has done over the last year or 2 years or 5 years, if you see the top 5 mutual funds, that doesn't necessarily tell you, I want those?
Yeah, unfortunately, there's been some research on that as well, looking at that past performance and some of those rankings. Once again, it depends on the time frame they're looking at. Some of the more interesting research actually shows that if you pick the lowest rated funds, those tend to actually do better over the next period of time because it's all relative, right? So let's say over the last 10 years, emerging markets have done really well. So you say, okay, well, that's what I'm going to buy. And then you hold that, and then for the next year, it does horribly compared to the U.S. stock market. So to try and look at the performance and some of these rankings,
it's kind of like trying to time the market.
Misleading, right.
Is there anything you tell people, back to the fact that some mutual funds are in stocks, some in bonds, and some a combination, does your age or your risk tolerance steer you in one direction or another?
It does. There's a number of factors to consider. One's your investment objective, your time horizon. So that's often can be tied to a person's age.
Because if you're 55 and hoping to retire soon, or
you're probably going to have a different allocation than somebody in their 20s. And so what we found is there's a lot of good resources that will often be part of the company retirement plan. They may have like a risk tolerance questionnaire, a series of questions that you can go through to get an idea of what kind of mix should I have, because everybody's mix is different. So it's hard to say on a general basis what somebody should own without understanding some of these other factors.
Yeah.
And risk tolerance, that's a huge one, Mick.
Yeah.
And how I would define that is your psychological ability to kind of handle the ups and downs. You said earlier that stocks typically do better than bonds. Well, that's definitely not the case if you have a very low risk tolerance. And after the slightest decline in stocks, you end up selling them.
And then
because you're never around
to
benefit from the higher returns.
Right.
So that's a huge factor to consider.
We're getting near the end, but I noticed you brought a couple other books. Why don't you mention anything you recommend to people?
Right. So that first one, The Behavior Gap by Carl Richards, I already mentioned that earlier. Not only does he talk about investing, but he also goes into other areas of personal finance with a lot of great illustrations. So it's very easy to read. You don't need a degree in finance by any means. Another book that I really like is called The Investment Answer by Daniel Goldie and Gordon Murray. One of the reasons I like this book is it's under 100 pages. So when I recommend it, people actually read it because you can read it in an hour to an hour and a half. And it gives a great overview of, quite frankly, a lot of the things that we just talked about today with the references to some of that research that I mentioned. The third book, for someone who really wants to dig in a little bit deeper, is called A Random Walk Down Wall Street, which is written by a professor out of Princeton. And he's actually written a number of editions of it, so he keeps updating it with more information, but it goes into a lot more detail as to some of these concepts that we talked about today.
Okay. Well, we'll definitely have you back on the show, Justus. You and I have talked about some other topics that we're going to do in the future. Last quick question, what's one really hot stock tip for people? Just kidding. You've been watching Money Talks. I'm business reporter Michael Burke. This is Justus Morgan from Financial Service Group. Thanks to our producer, Scott Anderson. And check out our archive page on the Journal Times homepage, from the Journal Times homepage. Thanks a lot for watching.